Why do most people lose in crypto over the long run, even if they get, really lucky in the short term? It really just comes down to human behavioral biases. So, okay, let's unpack this.
Let's do it.
Welcome to Bitcoin Deep Dives by MyCryptoParadise. I am just thrilled to have you with us today because, well, we have a very specific, highly tactical mission for this deep dive.
Yeah, we really do. We are basically opening up the actual playbook of Simon today.
Right.
And, he's one of our elite traders from the Paradise team. So our whole goal here is to completely dismantle that gambling mindset that it traps so many retail traders. We want you to step directly into the shoes of the pros.
It is such a critical transition to make, too. And just so you know where we're pulling this from, our source material today comes from direct transcripts of a recent MyCryptoParadise video analysis.
Which is great because it gives us this perfect window into the exact professional trading mindset, the psychological discipline, and the actual technical strategies that Simon uses.
Exactly. We're going to look at the market through a totally different lens than the average retail participant.
Yeah.
But before we get into those specific strategies, I do want to set a quick baseline here.
Okay.
Because there's one specific data point mentioned in our sources today that I feel like we just need to put on the table right off the bat.
Oh, right. The Ethereum sale.
Yeah. So the source notes that a crypto wallet linked to Trump's World, or Liberty Financial, recently sold $19 million worth of Ethereum.
That's a massive number.
It is. But I want to be crystal clear with you, the listener, right now. We are addressing this with strict, impartial neutrality.
I hope so.
We are simply reporting this factual data point directly from the source material. We're not taking any political side, we're not endorsing any viewpoint, and we're definitely not making any commentary on the individuals involved.
No, not at all. Our focus here is entirely on the data. We only care about how the market reacts to large capital movements like that.
Right, because that is the only way a professional actually operates. The market fundamentally does not care about your politics.
Well,
it doesn't care about the news headlines.
It cares about liquidity, volume, and human behavior. That's it. And, understanding that behavioral piece is really the first step in understanding how professionals avoid emotional trading altogether.
Right.
They view the market itself not as some random number generator or like a slot machine. They see it as a living, breathing entity.
Okay, wait. I actually want to push back on that a little bit right away.
Go for it.
Because when you say living, breathing entity, it sounds almost, mystical.
Yeah, I get that.
Like, I know Simon uses Elliott wave theory, which operates on this exact premise. But let's be honest here. A lot of retail traders look at Elliott waves and they literally call it astrology for men.
They do. I hear that all the time.
Right. It just looks like people drawing arbitrary lines on a chart just to fit whatever their inherent bias is.
Yeah.
So how does Simon actually use this as hard, objective data?
That is a very fair skepticism, honestly. And it's a trap that so many amateurs fall into when they try to use the theory without really understanding it. But Elliott wave theory isn't mystical at all. It is literally the mathematical measurement of mass psychology.
Okay.
Markets are operated by millions of humans, right? And human behavior, our collective greed, our fear, our optimism, our panic, it creates these very predictable rhythmic patterns.
So we all react the same way.
Exactly.
Yeah.
When a million people panic, they don't just do it randomly, they do it in a cascade. So when Simon is mapping an Elliott wave, he is essentially mapping the biological rhythm of the crowd.
So it's basically the visual footprint of human emotion playing out in real time.
Yes, exactly that. And the most fundamental part of that rhythm is the concept of inhales and exhales.
Inhales and exhales. Okay, break that down for me.
So an inhale is what the theory calls a motive wave. It represents this big surge in market action, usually driven by collective optimism or FOMO, but it doesn't just shoot straight up in a single unbroken line.
Right, it never goes straight up.
Never. The theory states this inhale is actually subdivided into 5 smaller steps. So you have a push-up, then a slight pullback, another big push-up, another pullback, and a final push. So it's like inhale, exhale, inhale.
Oh, wow. Okay, so that 5-wave sequence is what drives the market strongly in one direction.
Precisely.
I'm trying to visualize this, and here's where it gets really interesting to me. It's like watching a marathon runner.
Okay, I like that.
Yeah, so you're watching this runner sprint up a steep hill. That sprint is your motive wave, right? The big inhale.
Yep.
But nobody on Earth can sprint infinitely. Eventually, that runner has to stop, put their hands on their knees, and just catch their breath.
They have to.
And that rest period is the exhale. Now, what does the retail trader do in that moment? They see the runner stop moving forward, they totally panic, they assume the race is over, and they just sell everything.
They dump it all.
But pros like Simon aren't panicking at all. They're basically just sitting on the sidelines with a stopwatch, waiting for the runner to finish resting.
I really love that analogy, especially the idea of the stopwatch, because the market's rest periods, those corrective waves or the exhales, they have very specific structures.
Okay.
Now, our sources mention some incredibly dense technical terms for these, things like a WXYX 333 formation or an ABC flat pattern.
Wait, let me stop you right there, because for someone who doesn't just stare at charts all day, WXYXX is just meaningless alphabet soup.
Fair point, yeah.
What does that actually look like to a normal person?
Okay, so think of an ABC flat pattern, like a ball bouncing down some stairs. The market drops sharply. That's your A. Then it tries to rally and bounce back up, which gives amateur traders all this false hope. That's the B.
It's like classic track.
Exactly. But it fails to break through, and it drops a second time to scrape the bottom again, and that's the C.
Oh, I see.
And the WXYXX thing. That is just a more prolonged, really complex version of that exact same bouncing. It's an exhaustion phase. The market is just chopping sideways, grinding people down, basically shaking out all the impatient traders before the next big sprint.
That makes so much sense. So the real question then is, how does Simon's stopwatch actually work? Like, if he knows the market is catching its breath, how do pros know exactly where the market is going to take that breath?
Well, what's fascinating here is how he uses multi-time frame analysis. He pairs that with Fibonacci retracement levels.
Okay, multiple time frames.
Yeah, so he's looking at the weekly, the daily, the 4-hour, and the 1-hour charts all simultaneously. By zooming in and zooming out like that, he gets a complete picture of the market's cycles. And then he layers in those Fibonacci levels, specifically the 0.618 and the 0.786 levels.
Wait, why those specific numbers, though? Why does a completely chaotic market care about some specific mathematical ratio?
Because human psychology naturally seeks equilibrium. Those ratios, which are tied to the golden ratio, they appear everywhere in nature, right? Then they appear in market sell-offs, too, because they represent the exact point where human panic finally subsides and perceived value kicks in for institutional buyers.
Oh, wow.
Yeah, the market doesn't drop randomly. It naturally gravitates toward these mathematical landing pads. So when Simon sees a complex exhale approaching a 0.618 level, and it aligns perfectly across the daily and the 4-hour charts, he has found a high probability point where that exhale is mathematically likely to end.
Man. Okay, so if these Fibonacci levels are mathematically sound,
Yeah.
and the breathing patterns are measurable, why do so many people get absolutely decimated in this market?
Because of exactly what you said in the intro, behavioral bias.
Right. I mean, if the data is literally right there on the chart, why do so many retail traders get completely liquidated right at those exact lines? Like, what is the trap that's being set?
It's because the masses operate almost entirely on anticipation and emotion. They have extreme FOMO. The sources point out this really fascinating behavioral shift that happened after the massive crypto crash in 2021.
Oh, the arrogance phase?
Yes. Retail traders developed this massive, incredibly dangerous bias. Because they lived through that horrific crash, they arrogantly assumed they could just outsmart the market the next time around.
Yeah, I remember that.
They developed this catch-the-bottom mentality. So instead of waiting for confirmations or those mathematical landing pads, they see a massive drop and they think, I am a genius. This is my lifetime opportunity. Everyone else is scared, so I am going to buy.
But they are doing it entirely on feeling. Like, they aren't waiting for a completed ABC pattern or a Fibonacci confirmation or anything.
Nope.
They just smash the long button with huge leverage, usually right at major resistance levels, like a descending trend line or a moving average. They honestly think they're outsmarting the room, but they're actually just wandering onto a battlefield with zero armor.
And waiting on that exact battlefield is smart money.
Right. The whales?
Yeah, we use that term a lot, but what it really means is the tiny minority of institutional players who hold the vast majority of the capital and the connections, they do not trade on emotion. They trade on data. And one of their absolute favorite pieces of data is VPVR volume.
Okay, let's break that down for the listener. VPVR.
Volume Profile Visible Range. But without getting bogged down in the acronym, just think of it as a heat map of receipts.
A heat map of receipts. I like that.
It shows you exactly at what price levels people have bought and sold. So smart money can look at this map and see a massive, glaring red bullseye showing exactly where thousands of amateur retail traders are suddenly stuck in highly leveraged long positions.
Okay, so they see the trapped retail traders. What do they actually do with that information?
They completely exploit it. Look, if smart money wants to sell millions of dollars of Bitcoin to take profit, they can't just dump it on the open market. It would crash the price instantly and ruin their own profit.
Right. There wouldn't be enough buyers.
Exactly. They need buyers. They need what we call liquidity. So they look at all those overly eager retail traders who are desperately hitting buy, and they use them. They sell their massive bags right into that retail buying pressure.
Oh, man.
And once smart money is done distributing their Bitcoin, all of that buying support vanishes. The price plummets, hitting the stop losses of all those retail traders, which forces automatic selling, creating this cascading, violent crash.
It's ruthless. I mean, the smart money literally uses the emotional panic buying of the retail crowd as a cushion to exit their own position safely.
They do it every time.
And this brings us perfectly to the anatomy of a fake out. The source material had this incredible breakdown of how you can actually spot this trap being sprung in real time right on the chart.
Yeah, the fake out above resistance is just a masterclass in market manipulation. But first, we need to understand what a real healthy breakout looks like. If a price breaks above a major ceiling, you need to see rising volume on the initial push. That proves real capital is stepping in. Then, when the price naturally ducks back down to test that ceiling, which is now supposed to act as the new floor, you need to see declining volume.
Meaning what, exactly?
That tells you the sellers are weak, they've run out of ammunition, and the floor is actually holding.
But the fake out that Simon analyzed from the Paradise team playbook showed the exact opposite data, right?
Complete opposite. The price pushed above the resistance line, and retail traders immediately got euphoric. They saw the breakout and threw their money in. But Simon looked at the volume, and it was practically non-existent. There was no real institutional capital behind the move at all. It was a ghost.
And then came the retest.
Yep. When the price dipped back down to test the line, the volume from the bears was actually rising.
Wow.
The sellers were gaining massive strength at the exact moment they were supposed to be getting weaker. The floor wasn't holding at all. It was a trapdoor.
You know, a lot of deep dives will compare this to a gambler at a roulette table betting on red just because it hit black 5 times. But I actually think that's the wrong analogy.
Oh, yeah. How so?
Because roulette is pure chance. This is more like walking into a casino where you are an emotional tourist, but you're playing against the casino's risk manager.
Oh, that is a great way to put it.
Right. The tourist has had a few drinks, feels lucky, and bets their mortgage just because the lights are flashing. But the risk manager is just coldly looking at the mathematical probability of the house edge. The professional trader is acting like the casino itself. They refuse to play the game unless the math dictates an edge. They don't buy the fake out, they wait for candlestick confirmations.
Candlestick patterns are really the ultimate lie detector in all of this. The sources mention looking for very specific rejections.
Like what?
For example, a bullish hammer candlestick pattern. That's a candle with a very long wick at the bottom, which visually proves that sellers tried to push the price down, but buyers fiercely and violently rejected the drop.
I see.
Or, on the flip side, a bearish engulfing pattern following a shooting star. That proves mathematically that the sellers have completely swallowed up the buyer's momentum.
Okay, so we've identified the traps. We know the masses get slaughtered because they get trapped by their own biases and get exploited by the whales. So how do you actually build a system that removes this bias?
That is the big question.
How does the MyCryptoParadise team position you alongside the smart money instead of the plankton? Because, you can't just tell a human being, don't be emotional. That never works. You have to give them a framework that replaces the emotion.
Exactly. You replace it with a total obsession over divergences and extremes. Let's go back to that $19 million Ethereum sale linked to the Trump's world that we mentioned earlier.
Yeah.
An amateur sees a massive headline like that, their heart rate spikes, they assume the insiders know something terrible, and they panic sell their entire portfolio. But a professional doesn't even blink at the headline. They literally turn off the news, open the chart, and look at the cold, hard data of momentum.
They use indicators. And the sources specifically list 3, RSI, MACD, and stochastic RSI.
Yeah.
But I want to pause here for a second. Why use all 3? Aren't they basically just telling you the exact same thing?
They do track momentum, but they do it in subtly different ways, which is why Simon layers them. So the RSI, the Relative Strength Index, measures the speed and magnitude of recent price changes. It basically tells you if something is broadly overbought or oversold.
Okay, got it.
Then the MSE moving average convergence divergence that tracks the relationship between two moving averages of a price. It tells you about the actual strength and direction of a trend.
And the third one?
The stochastic RSI is highly sensitive to short-term movements, so it acts like an early warning system. By combining all three, you filter out the false signals. But the key isn't just looking at whether the lines are pointing up or down. Simon is specifically hunting for divergences.
A divergence. Okay, let's paint a picture of this for the listener. What does a divergence actually look like, and why is it the holy grail for a trader?
Think of a divergence as a fundamental disagreement between the outward appearance of the price and the internal engine of the market's momentum.
A disagreement.
Yeah. Imagine you are driving a car up a really steep hill. From the outside, the car is still moving forward, getting higher up the hill. That's your price action making a higher high.
Right.
But inside the car, the engine is sputtering, the RPMs are dropping, and the gas tank is practically empty. That engine is your momentum indicator. So even though the car is visibly moving up, the internal data tells you a stall is absolutely imminent.
Oh, wow. So applied to a chart, if Bitcoin's price drops and makes a terrifying new lower low, the retail crowd totally panics. But Simon looks at the RSI, and the RSI actually makes a higher low during that exact same time frame.
That is a classic bullish divergence.
Incredible.
The outward appearance is extreme weakness, the price is falling. But the internal engine, the selling pressure, is actually running out of gas. It tells a professional that the sellers are exhausted, and a violent reversal upwards is highly probable.
So it's looking into the future almost.
Well, price action is often a lagging indicator, right? It tells you what just happened. Divergences are leading indicators. They give you a high probability clue of what is about to happen.
The sources also talk about mapping out the actual battlefield, too, not just looking at momentum.
Yes, using liquidation maps. These maps act like literal magnets on a chart. They visually show where massive pools of leveraged retail capital are just sitting there.
Waiting to be taken.
Exactly. Smart money will naturally push the price toward those exact clusters to trigger the imbalances and grab that liquidity. Simon watches these maps to see where the price is magnetically drawn.
And he pairs that with the fear and greed index, right?
He does, which you can track right on MyCryptoParadise.com, actually. It is a brilliant gauge of market extremes. When the crowd is exhibiting maximum blood in the streets fear, the probabilities suggest the market has exhaled completely, and it's time to look for a bottom.
And when they're euphoric.
When the crowd is euphoric, it's time to prepare for the drop.
Okay, so this brings us to the most pressing question. If we connect this to the bigger picture, what is Simon actually seeing in the data right now? When he applies all of this, the waves, the Fibonacci landing pads, the divergences, what is the actual outcome?
His current analysis is really a masterclass in holding multiple probabilities at once. Based on the current motive wave structures and the momentum indicators, he sees a high probability target of $77,000 to finish the current upward wave.
77,000, okay.
But, and this is the true mark of a professional, he does not marry that bias. He is simultaneously preparing for the possibility that the market might trigger a larger macro first wave correction.
Down to where?
If the data shifts, that correction could pull the market all the way down to $44,000.
Wow. And he just holds both realities in his head without panicking. He isn't making the blind guess at all.
Not at all. He plots the waypoints for both scenarios. He waits for the 5-wave inhale to complete. He watches the MACD and RSI for those divergences to confirm weakness, and he just lets the data tell him which path the market is taking.
So what does this all mean for you, the person listening to this right now? It means recognizing that the entire ecosystem, the flashy Twitter analysts, the panic-inducing headlines, the dramatic price spikes, it is all actively designed to make you act impulsively.
It's a noise.
Exactly.
Yeah.
A professional sizes their position based strictly on the mathematical probability of a setup. They protect their capital with precise stop losses. They never, ever use blind hope as a trading strategy.
Which leads us to the most critical part of this entire deep dive, really. It is one thing for us to sit here and explain these concepts. It is another thing entirely to execute them day in and day out when the market is plunging 20% and your brain is just screaming at you to sell.
And that is exactly where the human element actually becomes a strength, provided you are in the right environment. I mean, We've covered the mechanics, the breathing of the waves, the fake-outs, and the momentum indicators. But none of that math matters at all without an unwavering psychological discipline.
You have to have it.
And that discipline is the foundation of the MyCryptoParadise family. I'm going to speak directly to you for a second. Navigating the crypto markets alone is brutal. It feels isolating, it's volatile, and your own behavioral biases are constantly trying to trick you into making the wrong move at the absolute worst possible time.
It's exhausting.
But being part of the MyCryptoParadise VIP family changes that dynamic entirely. You are no longer trading alone in the dark. You are surrounded by an elite community. You receive personal trade setups from pros like Simon with crystal-clear entry targets, take-profit zones, and stop-losses. It is the profound difference between wandering blindly through a minefield and walking behind a seasoned guide who possesses a map of every single explosive.
That discipline is the map. And the source material actually provided Simon's exact professional mantra. It perfectly encapsulates everything we've discussed today, and it really serves as the blueprint for survival in this market.
Oh, read it. That's vital.
Here it is. Thinking probabilities, not emotions. And I remain calm and disciplined in every market condition. I follow my trading system with precision and patience, waiting only for high probability setups.
I love that. Waiting only for high probability setups. He isn't forced to trade every single day.
No, he's not. And he continues. I respect risk management and protect my capital above all else. Losses are feedback that sharpen my strategy, and wins are the result of disciplined execution.
Losses are feedback that sharpen my strategy.
Oh.
Let's just pause on that for a second, because that is the fundamental divide between a gambling mindset and building generational wealth.
It really is.
A gambler takes a loss personally. They view it as a personal attack or just terrible luck, and they immediately try to revenge trade to win it back, usually losing way more in the process.
Almost always.
But a professional views a loss merely as the cost of doing business. It is just a piece of data that refines their edge. The market simply does not care about your feelings. It does not care if you're having a stressful day or if you really need a specific trade to go your way.
The market doesn't know you exist.
Right. But a disciplined, structured philosophy like the one instilled at MyCryptoParadise takes that chaotic, uncaring market and transforms it into a systematic tool that actually works for you.
We have covered incredible ground today. We completely reframed how to look at the market. It is not a machine. It is a breathing organism driven by human emotion with massive inhales and measurable exhales that we can track using Elliott waves and Fibonacci ratios.
We totally exposed the behavioral traps. We looked at how the trauma of past crashes creates arrogance, causing retail traders to try and catch falling knives without any data. We dismantled the anatomy of a fake-out, showing exactly how smart money uses the eager impatience of the masses to generate the liquidity they need to escape their own positions.
And we explored the toolkit used to fight back, ignoring the noise of headlines, looking beneath the surface price action using momentum divergences, and relying on data like liquidation maps to align our trades with the smart money.
Yeah.
All of this culminates in adopting the emotionless, probability-based, highly disciplined mindset of the MyCryptoParadise professionals.
It is a complete paradigm shift. Once you see the market through this lens, you can never go back to just staring blindly at a chart.
You really can't. And as we wrap up this session, there is one final lingering thought I want you to take with you.
Let's hear it.
It's something to seriously consider the very next time you open your exchange app. We've seen exactly how smart money relies on the predictable, emotional reactions of the crowd. They mathematically need retail traders to panic buy at the absolute top and panic sell at the absolute bottom.
They depend on it.
They do. So knowing that your own emotional reactions are the exact liquidity someone else is relying on to get rich, the next time you feel that urgent, panicked, heart-racing need to aggressively click buy or sell, you have to pause, take a breath, and ask yourself, are you executing a carefully planned, high-probability strategy? Or are you just providing the oxygen for the market's next exhale?
Wow. Are you the casino's risk manager, or are you the emotional tourist?
Thank you so much for joining us on this deep dive into the MyCryptoParadise playbook. We hope you walk away from this feeling empowered, sharply informed, and ready to approach the market not with fear, but with the cold, calculated precision of an exclusive trading family. Until next time, stay disciplined and trade smart.